So I want to thank you all for coming to this makeup lecture for the lecture that was snowed out. We're very happy to have extraordinary speakers today to come and tell you about their work and the biopharma industry. Now, as you know, usually I begin the class with an hour and a half of my lecturing, but because the quality of the speakers today, there's nothing that I could possibly add, so I'm going to just shut up and introduce them and let them take the full time to describe to you what they do. I'd like to start by introducing our first speaker, Pablo Legorretta. So Pablo started out as an engineer, but then chose a field of finance to make his career and worked for many years as an investment banker at Lazard. And in 1996, decided that he was going to create a company focused on investing in drug royalties. And I actually discovered Royalty Pharma quite late in the game. That shows you how ignorant I was. After writing this paper on using securitization to create portfolios of biomedical projects, I ran across Royalty Pharma and realized that they had done it, but they had the idea about a decade and a half before I did. And when you hear the story, you'll understand why this is such an important business model. And what Royalty Pharma has done is nothing short of extraordinary in having impact on the biomedical industry. So please join me in welcoming Pablo Legorretta.
Thank you, Andrew. And it's a privilege for me to be here today. I've been a huge fan of all of the work that you have been doing over the years to figure out how to finance better this industry. And so when you asked that I come here to talk to your students, I jumped at the opportunity. I think it's an industry with huge financing challenges. Now, as we start to see declines in government budgets, I don't know if some of you have, or any of you have actually seen that the Trump administration has proposed a budget cut of $6 billion to the NIH funding for 2018. Luckily, NIH funding is going to go up by $2 billion this year to $34 billion because that was part of the prior administration. So the funding of basic research in this country is at risk. And what's really concerning to me is that it's happening at a time when other regions of the world are really stepping up their funding of innovation in life sciences. And they're doing that because they've realized that this is a great industry where there's so much generation of knowledge and IP and innovation that leads to many other fundamental transformative technologies in many other industries. And China, for example, announced a 5-year plan of investment in science and technology of $300 billion, which is about $60 billion per year. NIH budget is $34. What China has said is that biotechnology is the priority of this $300 billion budget. So we need to actually figure out how to continue to fund this great industry where America leads, and leads by a long margin. And what I've done through Royalty Pharma over the last 20 years is try to figure out how we can transform the funding of life sciences through what we call collaborative capital. And the mission of Royalty Pharma is to actually make the R&D ecosystem that we are part of more efficient and productive. So with that brief intro, and also thanking you, Andrew, for the opportunity to be here, let me go through a little bit of the history of Royalty Pharma and what we're doing. And this first slide shows you the 20-year history. I started this business 20 years ago, actually 21 years in 2017. And it just shows all of the investments that we've made in many great products marketed by great companies. And I'll come back to that later. But this is an industry where one of the most fundamental aspects of its success is collaboration. And you'll see what's happened over a little bit more than a decade in terms of collaboration. So these are research papers where two scientists are collaborating and writing a paper. And you can see the flow of ideas, the flow of knowledge between Europe, the US, and Asia, and a little bit in Australia. And you can see how this has exploded in this 12-year period. And it's going to continue. I heard recently that this year is the first year where China, for example, has filed more patents than the US has. So again, it's a bit of an illustration of why there is concern in us falling behind. What this caricature depicts is the theme of this talk, which is co-transformation and how powerful co-transformations can be. And it was an invention of using a living organism where scientists figure out how to insert the human sequence of a protein into the DNA of a unicellular organism and have this organism produce human proteins. And you'll see that I'm going to go through an example later of a great drug that we've invested in, upogenulasta, which is produced through one of this. It's essentially a factory, but it's E. coli cells that are producing a human protein that has tremendous use in oncology. And what I'm going to talk about today is how the R&D ecosystem has been transformed at 3 levels. First, very quickly, just from a scientific perspective. Second, the structure of the industry and how it's been transformed. And last and third is how the financing of the industry has been transformed. And this is where we have played a role and want to continue to be very active on this third part of the co-transformation of the R&D ecosystem. So to talk about the science part of it, I think a really, really important aspect of this transformation has been the emergence of biotech. Because what happened is that we went from sort of an old way of doing science, which was, all of this was generally happening within the walled gardens of big pharma. This is maybe 50 years ago or before that. And what was happening was really organic chemistry, producing small molecules. And this led to great drugs, but there was not a lot of collaboration and also not a lot of licenses and royalties. But this all changed with the emergence of biotech. And it's maybe 30 years ago. And then I highlight here a few really important events, and there's many more than the ones I highlight, but there was a joint discovery between scientists at Stanford and UCSF, with this idea of using, being able to produce recombinant proteins. And it was Cohen and Boyer that did that. And then there's a few other things that have happened that I think are quite interesting. First was the passage of the Bayh-Dole Act in 1984, I believe, or 86. And what this did is that there was a big question with government funding. NIH was giving grants to academia, and the question was, who owns the IP? Who owns the valuable asset that is produced? Is it NIH that gave a grant? Is it the university where it was discovered, or is it the scientist? And what the passage of this law did is that it actually gave ownership of the IP to the university, but it also forced universities to come up with very clear policies as to how the economics that result from the invention are split between the scientist and the university. And today we have an environment where, depending on the university you're at, if you're, for example, at Columbia, I believe it's about 25% of the economics go to the inventors. At Emory, it's about 40%. At UCLA, 40%, and NYU, for example, 47.5%. So it ranges from about 20% to about 50% of the economics are shared with the inventors. But it really clarified this question of ownership of the IP. There was another important event, which was this case that went up to the Supreme Court, which decided that you could patent life forms. I've talked about the co-transformation invention. And then other things that I think are important were the annotation of the human genome and this race between Craig Venter at Celera Genomics and the Institute for Genomic Research to map the human genome. And this obviously gave us a tremendous understanding of how humans and actually living organisms work, how our bodies work, and really allowed us to navigate this amazing field with not in the dark, but with a lot more knowledge of how things work in the human body, which allow us now to actually be a lot smarter in the way we develop drugs. So what's happened through this decades of transformation and the emergence of biotech is that we now have a much richer R&D ecosystem, one where you have many more participants that contribute to the development of a drug, a therapeutic, or a device. And what's happened, it's more fragmented, more specialized, but what happens is that all of these participants get compensated. So there's a license generally that's entered into, and a royalty, and that's how all of these participants get compensated, because what happens is that all of these different, sort of techniques or approaches are owned by different parties, and obviously they're contributing to the development of a drug. And we have now an industry where you have not only small molecules, but you have very complex products. This is Humira, where we have a royalty, and it's a much more complicated molecular structure, bigger molecule. In terms of the transformation of the life sciences industry, what's happened, and this is also has been very important, is that we went from the old model of the fully integrated pharmaceutical company, where you had companies doing everything from basic research through clinical trials and then commercializing drugs. And think of this as Pfizer 40, 50 years ago, that would do everything along this path. And a much, again, more dynamic and richer ecosystem where we have governments that are funding research, entities like National Institute of Health or CNRS in France, Weizmann in Israel, and funding academic labs. And then you have biotechs, which are here in the middle, and generally things get invented here, licensed to biotechs. Biotechs end up funding phase 1, phase 2 clinical trials. When they're getting close to phase 3, they approach a big pharma to try to license their invention or their product. They show the phase 2 data to the big pharma, and they try to license that to a big pharma. And they're also at that point, they need money to fund phase 3, which is expensive, but they also are looking for a partner that will help them to distribute the products on a worldwide basis. What's happened in this industry is that, in my view, a lot of the innovation today, a lot of the creativity is really at academia and biotech. And big pharma has really become sort of the marketing arm of the industry, because these companies are large and they have worldwide distribution. But this new ecosystem is one which has created a lot of licenses. When an academic institution licenses the invention to biotech, there's a license and a royalty. And that again happens when the asset is transferred from biotech to big pharma. So what's happened is that when you look at what's the most valuable asset in this industry, which is the patent, intellectual property, and know-how, this was for decades, and this is sort of the key value driver in life sciences, and this was for decades locked up within government agencies and big pharma until the following 4 things happened. And this is my view of how I think this has been transformed. So we have sort of 4 driving forces that have transformed the R&D ecosystem. And I think and what you see here is government agencies, again, NIH and Weizmann, CNRS in France, that are really the fuel, the grants that they provide to academia is really the fuel that drives the academic research engine. And what you see here is the tremendous increase in the funding of NIH from small amounts, it was billions of dollars, but in the early 60s, and it ramped up to about $30 billion by 2010. Sadly, it has stayed flat for the last sort of 7 years. And as I said, the current government budget that was approved through a continuing resolution a few weeks ago has this increasing by $2 billion to close to 34. But the question is what's going to happen after that. And I think all of us here, if we really care about innovation and the lead that this country has, we should be concerned about this. And if you can, get active, call your congressman and say, this is really important, we cannot stay behind, I think it will be helpful so that, we can make sure that it doesn't decline and it continues to grow. So what happened is that as, this NIH funding increased in the US, and a lot of money was, and grants were given to the academic research engine, a lot of inventions and patents started to originate at academia. And what, in my view, also happened is that there was a need at that point for a much more entrepreneurial, business, not big pharma, which, unfortunately couldn't really respond to the needs, but there was a need for a much more entrepreneurial entity that could be more nimble, more, take risk and take all of this IP and inventions developed at academia and then try to convert them into products. And that's really the why we have this amazing biotech industry in this country. The other thing that happened is that the US financial markets were willing to support this new nascent industry. And there's an interesting anecdote. When I actually came to New York in 1990, I had been working at Lazard Frères in Paris in the late 80s. And I arrived in New York and realized that there were these amazing companies like Amgen and Genentech that were public companies. And these companies were losing money every year and had been losing money for 5 years or more. And it was a shock to me to see the contrast with Europe, where in Europe, for example, to take a company public in the 80s, depending on the exchange, whether it was the London Exchange or the Paris Exchange or the Frankfurt Exchange, you needed to actually demonstrate at least 3 years in some cases of profitability and other cases 5 to the exchange and audited profits. So a company that was not making money couldn't go public. And for me, the contrast with the US markets, which were willing to finance these companies that were losing money, was really stark. And I sort of concluded these markets are much deeper, willing to take risk, and they're much more developed. And when you look at the US financial markets, you obviously have also a very vibrant venture capital industry. And we actually are missing your firm here, which is probably one of the best in the world. And for the next time I show this, I'll for sure include it. But you also have this great institutional investors that have been hugely supportive to biotech. So this became, in a way, sort of the fuel that drives this other research engine, which is biotech. And then when we look at the track record of biotech, it's really extraordinary. And what this shows you here on the left, this chart, is that back in 2000, there were, this chart shows you the top 30 drugs back in 2000, with Prilosec being the biggest drug, selling $6 billion. And all of them had cumulative sales of $69 billion in that year. But what you see here is that there were 4 biotech drugs, the ones highlighted in blue, 2 of them developed by Amgen, 1 licensed to Genentech, and the other one kept by Amgen, Epogen. And then 2 biotech drugs developed by big pharmas using biotech techniques. But these drugs had sales of $7.7 billion, which is 11% of the 69 billion. So biotech, even as recently as 2000, was not a dominant, or important factor in this industry. But if you look at how this has changed, it's really remarkable. So when you look at 2015, the top 30 drugs in the world had sales of 165 billion. Humira was the biggest drug, or is the biggest drug, with I think this year it's going to probably did $16 billion last year, and this year it'll probably get to over 18 billion. But what this chart shows you is that all of the ones in blue, again, are biotech drugs. So of the top 30, 20 of them are biotech drugs, and with sales of $123 billion. And this now represents 75% of the sales of the top 30. One thing that really surprises me, or it's just an amazing feat, is the fact that of the top 10 drugs in the world, 9 of them are biotech drugs. And it shows you how this industry has changed. The other thing that you see in this chart is how this ecosystem works. And you see, as an example, Remicade was developed at NYU by Jan Wilczek, so it was an academic discovery. NYU licensed this to a small biotech, by Centocor at the time. And Centocor, once it had phase 2 data, it started to talk to Schering-Plough. Schering-Plough licensed the rights to Remicade from Centocor. And eventually, Schering-Plough was acquired by Merck, and that's why this product is in Merck's hands for the ex-US commercialization. But later on, Centocor, which had kept the US rights to Remicade, was acquired by J&J, and that's why this product now is it's the biggest product in J&J's portfolio, but it's obviously in the hands of big pharma. But what you see here clearly is the contribution of academia, with about almost half of the revenues of the top 30 products coming out of academic institutions, and also 75% of the products of the revenues of the top 30 coming from biotech companies. So it's a really profound transformation of this industry, and it really shows how wise U.S. Congress was to actually fund innovation through NIH at academia, and how that investment has delivered, and then the contribution of biotech. And this trend is going to increase. Actually, we did this analysis recently for 2016, and I think the 75% is now 77%. So it's obviously going to continue. So what's happened over the years as this ecosystem has been transformed is that we now have one of the biggest industries in the world. It's a $1.1 trillion industry when you look at sales of pharmaceutical products. When you compare this to other industries, you can see that it's really large. It's about 1.5 times the entire airline industry. It's about 4 times the laptop industry. So really big and important for the world. It's also an industry that has grown very predictably. There's never been a down year over the last 15 or so years. I think if we go back even further, it's probably have been growing for many more decades. And it's an industry that is forecasted to continue to grow to about $1.5 billion by 2020. I would tell you that with the experience we have in this industry, because this is the IMS forecast, that I think it's going to grow at this kind of rates for the next 10, 15, 20 years. And the reason it will grow very predictably is because of these 4 growth drivers that underpin the growth of the pharmaceutical industry. The first one is population growth, and this provides about 1% growth. The second is aging of population, and depending on the region of the world, it can add a point to a point and a half of additional growth. The third one is a really important one, more recent, over the last couple of decades, which is the fact that historically, if you look at the population of the world with 7 billion people, it was really about 1 billion of the 7 billion that really mattered for this industry, and it was the populations of the US and Europe and obviously places like Japan and Australia. But 6 billion people in the planet did not have the income levels that were high enough to really matter for this industry. But over the last 2 decades, this has changed in a very significant way, and we see sort of double-digit growth rates in this part of the world. The last and really important driver of growth is innovation. And what I mean by this is that if we step back, there's about 30,000 diseases that have been sort of described, and identified in humans. And we have treatments for about 6,000 of those 30,000 diseases, so about 20%. And these treatments are not ideal. There's still huge room for improvement in many of these treatments. But what happens in this industry is that you have unmet medical needs. So there's diseases for which there's no cure, no treatment. And if through innovation we're able to develop a drug that is going to address that unmet medical need, then you create these really significant markets. Examples of this, are, in the case of chronic lymphocytic leukemia, Imbruvica, for example, before the launch of Imbruvica, this disease was treated with chemos, and patients were not living long because the chemos were not that effective. So the sales of chemo agents in this kind of cancer were less than $1 billion. And the launch of Imbruvica is making patients live a lot longer, and obviously it's a very transformative product. So this will become probably a 10 billion plus market. And what happens in this industry is that you have always this unmet medical needs that are addressed through innovation. And maybe there's situations where, like in Lipitor, for example, the patent expires, the $14 billion of revenues that Lipitor had decline very sharply after the patent expires, 80% the first year, 50% the second year. So that market sort of, from a revenue perspective, declines. But through innovation, there's all of these other new markets that are constantly being created as we're addressing those unmet medical needs. A really important topic that obviously is today, in widely discussed in the press is the prices of drugs, and there's expensive therapies to treat many diseases. Cancer, there's obviously talk about $100,000 per year per patient therapies. And I'll say 2 things. The first is that when you look at how much the US spends in healthcare, it's about $3.1 trillion. This is about 2 years ago. So it's about 3.5 trillion now. But when you look at drugs, it's about 12% of the $3.1 trillion, so a very small portion. The vast majority of the expense is hospitals and doctors and dentists, and you can see that this is 58% of the cost. So if you think as a society or government, if we really want to impact the cost, it's a lot more important to focus on this part of the pie. And actually investing in drugs makes a lot of sense because you can prevent disease. If you give a patient Lipitor and prevent cardiovascular disease, you avoid very significant expense if the patient gets sick. And Lipitor today is incredibly cheap. It's a generic, so it was expensive for a while, but now it's very cheap. The second thing that I would say is that a lot of the things that you see in the press today are sort of the gross selling price of drugs, $100,000 per year. But what has been happening over the last 5-7 years is that there's significant discounting being given in the US to the big purchaser of drugs, Medicare, Medicaid, and also the big insurers. And in reality, when you look at how much the industry is really netting from the sticker price, it's really about 55% of the sticker price. So it's not as negative as the press may discuss it. So the third and last topic I wanted to go through is the transformation of the financing of the life sciences industry and what Royalty Pharma has done to contribute to this. And I'll first start by talking about some very interesting financings that were done years ago by a few companies, Amgen and Genentech. And if you look at these two companies, these companies have been very innovative, highly innovative, not only on the science side, but also in the way they have financed themselves. And in the case of Amgen, which is an interesting case study, this company was founded in 1980, raising $19 million in a VC round, private placement. And this company eventually went public through a $43 million IPO with a market cap of $200 million. The company had no revenues and had cumulative losses. And then what they did is that they negotiated an agreement with Memorial Sloan Kettering Cancer Center to license filgrastim, which is this product called Neupogen Neulasta that I mentioned early on, and agreed to pay royalties to Memorial Sloan Kettering. They also licensed other IP from other institutions, to be able to manufacture Neupogen in these unicellular organisms, also Columbia University. But this company, to finance the late-stage trials for this drug, did a highly innovative transaction at the time, or financing structure, which was, at the time they were called the R&D partnerships. And what this company did, Amgen, is that they actually dropped into a partnership the commercial rights and the patents to Neupogen, which they had licensed to Memorial Sloan Kettering. And actually what they had agreed to pay Memorial Sloan Kettering as a royalty was 3% of US sales and 5% of ex-US sales. And in this case, with these investors, they raised $84 million at a time when the market cap of Amgen was $400 million. No revenues, 1987. And the investors that invested in this partnership got royalties on the sales of the product of 7% US sales, 2% ex-US sales, and also warrants on the stock of the company. About 10% ownership potential, the ability to subscribe to 10% economic interest in Amgen, which was about a $40 million warrant package on an $84 million financing. And this money, I think another really key thing is that when you think of this company, what had been happening, in most cases, before this R&D partnerships, became an interesting way of financing a biotech business, was that Amgen would go with their phase 2 data to a big pharma and say, this is my phase 2 data, let's do a partnership. The big pharma would license the product, would give Amgen an upfront payment, would probably retain 80% of the economics, the big pharma, and leave Amgen with about 20%, and eventually launch the product. The fact that Amgen was able to finance the late-stage trials for this product and essentially retain 90% of the economics for this drug were critical. Today, Amgen is a $100 billion plus company, in my view, because they were able to keep 90% of the economics in this product. This product became a $6 billion drug, and it transformed the company. So it was a highly important, financing structure for Amgen at the time. And the way this was done is that there were 840 limited partners, high net worth individuals, doctors, that bought interest in this partnership for $100,000 each, and that's how the $84 million were raised. And these investors got this royalty on the sales of the product and warrants on the stock of Amgen. So what happened here is that by 1991, the product got approved and it was launched. The market cap of Amgen by then had gone up to about $4 billion. So these investors made 10x on the warrants from 400 million to 4 billion, and they were left with the royalty. So I realized that this had happened. These investors had these royalties, and with a couple of partners, we set up a partnership called Pharmaceutical Partners One and raised $7 million in equity, and with the idea to buy the royalties from these limited partners and provide them liquidity. Investors had made so much money on the warrants, 10x, that this idea of collecting the royalties was sort of boring. And we just felt that it was potentially a very attractive investment. We then negotiated with a bank at the time a $5 million credit line. And once we started to get cash flow from the $7 million of equity that we invested, we drew $3 million from that credit line and ended up buying $10 million worth of this Neupogen Neulasta royalties. And we bought 33 of the 840 interest, so a really small fraction of that. We did a second partnership in 93, 94, where we bought RioPro royalties. This was a Centocor product, funded also through a Paine-Webber partnership, R&D partnership, and here we invested $5 million. And I view these two partnerships as sort of proof of principle investment partnerships that allowed us to understand whether an investment in a royalty was viable and produced good returns. And once we did this and had this experience, and I also noticed that Memorial Sloan Kettering had a royalty because the drug had come out of Memorial Sloan Kettering. And then I was asking myself the question, could we create a business where we go to academic institutions where a lot of this research is happening and offer to monetize the royalty they own? And what that did is it essentially led me to leave this bank where I was working, Lazard, in 96, after about 10 years there, and to start Royalty Pharma. So we founded Royalty Pharma in 1996, raised $60 million, all equity, and started investing in royalties. And the first thing that I did was that I did a tender offer to buy more of these Neupogen royalties from these 840 investors. We had bought a small fraction, 33 of them. So in September of 96, we closed the $60 million financing, to start the business. And then by November, we had done this tender offer, and we bought about $20 million worth of Neupogen royalties. And then I did a tender offer to buy RioPro royalties also, went to the investors there, and we bought about $24 million worth of those royalties. And then what we did is we started to buy royalties from companies, scientists, and other holders. We bought a royalty on Rituxan from Zoma, royalty from Toby, from the inventor of Toby, and thalidomide, which was this old drug that caused birth defects in the 60s and was resurrected by a scientist at Children's Hospital in Boston as a cancer therapy. So we then do a rights offering in 98, raise another $60 million, a total of $120 million of equity. We invest that money. And by 2003, what I realized is the business had been funded with equity. We have now a diversified portfolio that was producing predictable cash flow. So we can put some debt on these assets. And what I did at the time was that I looked at the analyst estimates for products like Rituxan, for example, where we had a royalty, and realized that there were a lot of analysts that were following Genentech, very exciting company, were forecasting the sales of Rituxan. So if I took like the median analyst estimates and looked at how we owned a 2% royalty in that product, we could forecast a revenue. So it was sort of third-party estimates. And we did that for the entire portfolio. And then I went to talk to banks that were doing asset-backed securitization, and with the idea to raise some debt. And what these banks did is they said to me, well, if you forecast the revenues based on the analyst estimates, how much revenue will you get? And the answer was about $800 million at the time, over 10 years. So they calculated a net present value of that $800 million, which was about $400 to $500 million, depending on the discount rate that you used. And they said to me, you can probably raise $200 million, which was about 40 to 50% loan to value. So very conservative leverage. And if we looked at the revenue that we had in 2002, it was about $49 million. So the $200 million of debt was also about 4 times total debt to cash flow. very conservative again. And I was actually at a meeting at the time with bankers of Credit Suisse First Boston who were very good at asset-backed securitizations. And this is one of those things that, luck happens, chance. And a banker sitting in the back of the room after we finished the meeting approached me and gave me a prospectus of a financing that DreamWorks had done. This is Spielberg, Katzenberg, and Geffen for their film business. And I looked at it and I read this prospectus from cover to cover. And what I realized is that they had developed for the film business that they had an amazing financing structure. And what they had done was they had about 30, 40 films. So they had the studio that was producing the films, DreamWorks, and then they had a Delaware Finance Trust, DreamWorks Finance Trust, and they had realized that if, in the film industry, if you actually look at the first 8 weeks of box office receipts, how much the film produces in the first 8 weeks, and you look at the first weekend, which is typically the strongest in a film, and you look at the curve of how revenues fall off over 8 weeks, looking at that curve, it allows you to predict the future revenues that a film will produce from video sales, video rentals, international rights. Now, the model that they had worked because they had a diversified portfolio. Some would do better than expected, others worse than expected. But because it was diversified, it was predictable. And what DreamWorks was doing, which was fascinating, was that they would finish a film, and they would look at this 8 weeks. And if the film was going to produce, based on this 8 weeks of statistics, parameters, if they could forecast $300 million of future revenue, they would drop it into the trust and borrow incremental $100 million of debt. So, they had some debt already outstanding, but they would issue new debt of $100 million against the new film that they would drop that would produce $300 million. So very conservative. And they would use that $100 million to fund the next film. So it became an evergreen revolving structure with very low cost debt that was allowing them to fund their film business. And I looked at that and I said, my God, this is really interesting because we already have a diversified portfolio. And I had tried twice to buy Memorial Sloan Kettering's royalty in Upo Genulasta in '98 and then in 2000 and failed twice. And what was happening to us was that our cost of capital was too high because we were funded exclusively with equity. So what I realized is if I am now able to issue debt, and the debt that at the time we were able to issue, I'll show you what it was. So what we did is we copied DreamWorks' model. And DreamWorks, the studio was here, and they had this Delaware Finance Trust, so we did the same thing. And we had MBIA, and I don't know if you're familiar with what monoline insurers do. I don't know if you've, in the classes, have looked at this businesses, but it's very interesting. MBIA is Municipal Bond Insurance Agency. What the business that this company had at the time was to insure municipal bonds. And what they would do is that they would go to a municipality, in Greenwich, Connecticut, that wanted to build a school or a, bridge or whatever, and they would agree to finance or to guarantee bonds that municipality would issue, because they would look at the finances of the municipality, make sure that it was collecting enough revenues to pay back the debt, and they would agree to guarantee the principal. But so the business of MBIA was to guarantee financial instruments. And because they were AAA rated, you would essentially, when you were guaranteed by them, you would adopt their rating. So in our case, our portfolio by the rating agencies was rated single A when you looked at the diversification, the amount of debt that we wanted to put on it. But once we negotiated with MBIA to guarantee the principal on our debt, $190 million, we became AAA rated. So we went from single A to AAA. And what was key here was that because MBIA had agreed to guarantee our debt, we could go to the market and issue that debt and have investors buy it with almost no due diligence from their part because the bonds were guaranteed. So the execution risk was really low. And it allowed us then to finance our business at LIBOR plus 175 because we were paying 100 basis points to MBIA and 75 basis points to the investors in the market. So super cheap capital. And when I realized that we could fund our business with that cheap capital and that we had a portfolio, I said, because the logical thing for us to do, the conventional path would have been for us to raise this debt, give our investors a one-time dividend, and that's what I went to them and I said, I'm going to give you a $200 million dividend, which turned out to be 190. And the investors in Royalty Pharma were very happy with the outcome, and they said, why don't you start fund number 2? typical path of private equity venture capital. You go and you do fund number 2. And I knew that about 75% of our investors wanted to continue to invest. So I knew that about 150 million more or less would be seed capital for fund number 2. But what I realized is if I start fund number 2, all I have is capital in this vehicle, no assets. So, and it's all equity. And I cannot lower my cost of capital low enough to be able to pay a high price to Memorial Sloan Kettering to, incentivize them to sell the asset. And what I realized was that this structure was going to completely change the trajectory of our business. If I use this structure, I was going to be able to now lower our cost of capital, increase the price of the royalties, and be successful in opening up this market of academic royalties that was out there. But I sort of concluded if I do fund number 2, that market will be closed for us and we will never be able to offer a price high enough that would interest these academic institutions. So what we did is we changed the model, did not raise fund number 2. It was sort of not conventional. It was very difficult to convince investors to do it, but it was a very reasonable thing to do. And I sort of, looking back, call this sort of Royalty Pharma 2.0 because it was not conventional, but it gave us an amazing infrastructure and platform to grow the business. And that happened in 2003. So that moment, I re-engaged with Memorial Sloan Kettering. I went back to them and I said, would you mind if I make a third offer? The CFO told me, this is the third time. It better be the best because if not, it will be the last. And we ended up agreeing to buy from them this royalty for $400 million. Actually, we valued the asset at $500 million, and they agreed to sell us the royalty, 80% of it for $400, much higher price that I had originally offered. And the reason Memorial Sloan Kettering sold were there were really three drivers to their decision. Number one was the fact that the royalty was a very significant asset. If you looked at the endowment of the university, it was $1.6 billion of assets invested in many different things, bonds, stocks, real estate, but a very large royalty, concentrated risk. The trustees were very concerned on how dependent they were on this asset to fund the R&D of the hospital. So by selling us 80% of this, they kept 20%. They were able to diversify. Great outcome for them. And the second thing that happened was that they wanted to build this building in New York City, which at the time they were considering funding it with debt. And the rating agencies told MSK, too much debt, we might downgrade you. So the CFO took about $150 million of this $400 million that they got from us to fund the building, much more prudent thing to do. And now the building is finished, and it's probably one of the biggest research centers in the state, 21-story building where MSK has all of its scientists. They also have been funding research on a more accelerated basis. Instead of waiting to collect those royalties in small payments over 10 years, they can invest more quickly. The third thing that happened was that I realized that a royalty is an attractive asset. It's an asset that produces periodic payments. There's upside if the drug gets approved for other indications. There's also downside. That's why there's risk. But I had sort of concluded that these were very attractive assets for university endowments to own. Now the question is that it's way too big, which is what you're seeing here. So I realized, why not make this a win-win? If I can go to MSK and other universities and say to them, I'll buy it for cash, but you can take some of that cash and buy equity in Royalty Pharma, it will be a win-win because now you have a diversified portfolio as opposed to having one single royalty, concentrated risk, and finite life. It's going to expire at some point. And in this case, what I told the CFO is this royalty is going to expire in 10 years. It was 2003, so the Neupogen royalty expired in 2013, the Neulasta 2015. At the time, the CFO said to me, Pablo, I'm selling you the royalty. Why would I want equity in Royalty Pharma? And I said to Mike, you have a wasting asset. When your 20% expires, you will have nothing, no more cash flow. If you take equity in Royalty Pharma, first of all, it's a better risk because of the diversification. And secondly, if we keep on reinvesting, you're going to have cash flow for a lot longer to finance the hospital. And what happened, which was amazing, is they took the equity. We have now royalties in Royalty Pharma that go into the late 2020s, early 2030s, so it's about 15 years from now. The royalty expired in 2013, 2015. So MSK will receive cash flows from us for 20 more years. And if we keep on reinvesting, it can go on for much longer. And when you think about it, what an institution like MSK needs is predictable long-term cash flow, and that's what they're getting now from this transaction with us. So what happened is once I did that deal with MSK, I went just very systematically to all of these academic institutions, which I knew had royalties. And we did a deal with Emory, very similar to MSK. Emory became a shareholder of Royalty Pharma. The inventors of Emory became shareholders of Royalty Pharma. They owned 40% of a $525 million royalty. We did a deal with NYU for Remicade, which is that J&J drug that is really big, and many others. And then what happened was that the asset-backed securitization infrastructure we put in place in 2003, by 2007, we were growing fast. And one of the things that I started to feel was that MBIA, we had agreed with them that if we showed them assets that were attractive, meeting certain criteria, if they were approved, that they would fund us and grow with us. But I started to feel that this company, MBIA, was just not willing to grow with us like I wanted to, and I felt that they were going to start to really slow our growth. And I don't know if it was in part luck or the fact that maybe the financial crisis was sort of coming and they were starting to feel some issues internally. But I decided that I couldn't rely on the MBIA guarantee. And I felt that the market at that point knew Royalty Pharma well enough, our credit, that we could then go and issue debt without the MBIA guarantee ourselves directly into the market. And we did the first ever royalty-backed term loan B with $700 million. And again, we were not needing the financial guarantee of MBIA. And then we proceeded using that structure to acquire many more royalties in Humira and Lyrica. You can see here these great products. And what's happened with Royalty Pharma is that it has become a large business with really extraordinary revenue diversification. You can see here that we're much better diversified than Celgene. This is an $80 or $90 billion market cap company. In my view, the most exciting biotech company today with the best pipeline. And this company, with about $10 billion of revenue, has one product, Revlimid, that has sales of about $7 billion. So 2/3 of the revenues is one product. So you can see the concentration of risk. Amgen also much more concentrated than we are. So we're very well diversified. This is something that's critical for our lenders. You can see that this is actually the chart that I'm most proud of. If you look at the top drugs by 2015, we have royalties. These are the top 30 drugs in the world by sales. We have royalties in all of the ones highlighted in blue. So we have royalties in Humira, which is the biggest drug in the world, in Remicade. We used to have a royalty in Rituxan that expired. We collected this for 17 years. A royalty in Neupogen that also, or Neulasta that expired. This was the Memorial Sloan Kettering one. But we have 7 of the top 30 in our portfolio. I think this year we're going to add 2 more. Royalty we bought last year from UCLA on Standia, prostate cancer drug, and another one. But when you look and you compare the fact that we have 7 of the top 30 drugs and we used to have 9 of the top 30 with the big companies in the world, so you can see Pfizer in their portfolio, they market 4 of the top 30, and AstraZeneca, Gilead, Roche, about 3 of the top 30. So we have twice as many of the top drugs in our portfolio as any big pharma company. You can see here the revenues of Royalty Pharma over the last, sort of 11 years, going from about $160 million to about $2.5 billion. The EBITDA margin, we have about $60 million of expenses to run the business. So that's why we have an EBITDA. It's basically the revenues less $60 million. So very efficient when you look at EBITDA margin. And what's now happening with the business is that we've entered a new phase, which I sort of refer to as Royalty Pharma 3.0, where we're doing new things. And what we're doing now is we're getting involved in mergers and acquisitions. So we did a deal with a company called Forest Labs, which is now Allergan, very large company, where we teamed up with Forest to acquire a company called Furix for $1.1 billion. And what happened here was that Furix had essentially 2 assets. A royalty that we were interested in Nesina, a Takeda product, and a drug that was in development for a GI condition, Vyversi, that was of high interest to Forest because it fit very well with Forest GI franchise. So we teamed up with them. We bought this company for $1.1 billion. We took the royalty. They took the pipeline drug. And they did this. We did this after the phase 3 data for this drug came out, which was positive. Now, when you think about this, had Forest acquired Furix 100% themselves for $1.1 billion, they would be tying up $400 million of their own capital in a royalty marketed by Takeda, a passive financial asset. There's really no reason why Forest should own a royalty that's being paid by a competitor. So if they were to do that, tie up $1.1 billion in buying this company, it's a very bad use of capital in the R&D ecosystem. It's a much better allocation of capital if they don't buy the royalty, we buy it, because they can preserve this $400 million to invest in other products, invest in R&D. And I think this will become a bigger and bigger part of our business as we grow, getting involved in M&A with pharma companies. Another thing that we've started to do is invest in products that are not approved, which is riskier, but we are big enough that we can do this. And I'll quickly explain a few deals that are really transformative for us, and I think they're starting to be important for the industry. So we funded, Sanofi had a $1 billion phase 3 program in a diabetes product called Lantus, where this is a pen that diabetics use to inject themselves insulin daily. About 4.2 million people in the US inject themselves insulin daily. And Sanofi has 3 of the 4.2 million, so 75% market share. And they combine that product with a GLP-1 lixisenatide, which gives better glucose control to the patient, and actually patients lose weight, which is an extraordinary result for a diabetic. And we agreed to fund this for $400 million in exchange for a small royalty, single digit. So that became a very attractive thing for Sanofi. We did another deal with Pfizer, where we funded Ibrance, which is a cancer drug. So here we're teaming up with companies to fund R&D, and what we're really doing is we're expanding the P&L bandwidth for the companies because they can fund more programs by working with us, because we take some of the R&D expense. So just very quickly, I'll finish with another really important thing that we were successful in doing about a month ago. There's a totally separate business that is not Royalty Pharma, where we lend money to biotech companies, and we started this in 2009 through serial funds. And what we do is we lend money to a biotech, and the biotech pays. Biotechs in many cases will receive a royalty on a product that they developed, but it's being marketed by a big pharma. So that royalty is a very attractive asset. You can take the asset, put it into a bank remote trust, lend money to the biotech that they will use to fund their own pipeline, and we get paid through the royalty. So we've done this now, raising about $1.7 billion of capital, and we've done 21 deals where we're funding the biotech industry. And one of the things that we've realized recently is this is an incredible industry that is a voracious consumer of capital, where there's about $280 billion invested in life sciences and R&D per year. About $190 billion is invested by companies, and $100 billion by governments, NIH and other government agencies. So $280 billion. And I don't know if any of you have looked at this, but if you look at how much is invested, for example, by the cell phone industry, it's tens of billions of dollars. Computers, tens of billions of dollars. Oil and gas might invest a lot in maintenance of wells, but in innovation, tens of billions of dollars. So this is the only industry in the planet that invests at a scale which is hundreds of billions of dollars per year, 280 billion. And what's shocking to me is that there's no large-scale specialized lender. There are specialized lenders in many industries, in real estate, people that do mezzanine and other things. So there's none in the biotech industry. So what we realized is we've been lending through the serial funds to the industry in 21 deals. And what we wanted to do is create what we've done at Royalty Pharma, which is a permanent capital vehicle, because these vehicles raise money with investors, we invested in loans, and then as we get paid back the loans, we're giving back money to the investors, the principal and the interest on the loans. But the money always goes back to the investors. It's not permanent capital. And I felt that if we created a permanent capital vehicle that could grow and also borrow money, because if you reach scale and diversification, you can then fund the business with debt, which we cannot do at this scale. We need a larger scale. So what we ended up doing in March of this year is that we took some of the assets that we had in those funds and created a vehicle, Biopharma Credit PLC, which is now listed on the London Stock Exchange. And this vehicle owns today about $400 million worth of loans that produce cash flow, and another $400 million worth of cash. We raised $400 million of cash in the IPO, so about $800 million of assets. And the idea is to lend that continue to lend with the $400 million of cash that we have, and as we get the loans repaid, the ones that we have in the portfolio, we'll just grow. And hopefully, if we do this right, maybe in 2 or 3 years, this will be a multi-billion-dollar vehicle, $2-3 billion of assets that will lend to the biotech industry. And so the goal here is to create the first large-scale lender to this amazing industry that doesn't exist. And we hope that through the IPO of this vehicle, Biopharma Credit, that we will be able to achieve that. And we think it's a great platform for that. And I'm done. I don't know if I took way too much time, Andrew, but thank you for listening to me.
Thank you, Pablo. We're going to hold off questions until at the end. But I hope you understand why it was so important for Pablo to come here and tell us about what amazing things Royalty Pharma is doing. They've really transformed the entire biotech and pharma industry with their creative financing. And a lot of the securitization that was done after the financial crisis, and it was rated debt. So it was really impressive.